Hello ladies and gentlemen, how are you? This is Muhammad Al-Yahya. I would like from this short video to answer the most frequent question that has been asking by a lot of my followers and viewers of this channel, to talk about my indicators, my moving averages that I am most of the time using in my trading. First of all, let me thank TOPSTEPX for allowing us to utilize and use this beautiful platform, which helped me a lot to analyze and read the market. Let's go together to the chart and talk about it. First of all, everything that I'm saying here is not by any means a signal service or an advice to buy or to sell any share or any future or any contract or any financial transaction. I'm not a financial advisory. I'm not consultant. So make your decision, make your own decision as you see fit. Whatever I show and showed previously in the historical doesn't require to repeat itself again. The current performance doesn't indicate the future performance. The current and the historical performance doesn't indicate that is gonna be the future performance. This disclaimer is very important to understand. What I'm doing and what I'm using here, I'm trading Nasdaq. I use the 1000 tick chart, the 1000 tick chart to read the price action. Why I'm using tick chart, not time line? Because I believe that the candle without volume doesn't mean anything. So usually the volume will indicate there is a buying and selling actually happened during this candle. If I put time frame, maybe you find a huge candle but without any volume. So instead of having a volume indicator and other indicator, so I use the tick chart, which is helped me a lot during my trading. So I use 1000 in NQ, I use 500 in YM, and I use 2000 for ES. Sometimes it is 1000. So in ES, it depends on how is the volume on that day. Also, the micro Nasdaq in the tick chart will be different than the volume candles in the NQ. For example, here we have the NQ. Look at this NQ. For example, here when we go to MNQ, we will see it a little bit different. So you can see, let me remove all drawings here. See in here, you can see in MNQ we have the market making higher high already, and we have the prices already across the moving average. If we go back to NQ, it will be a little bit different. It is same higher high again, but you can see the blue line is still within that indicator. Why? Because the volume traded in NQ is different than the volume traded in MNQ. This is why. If we go to basic time frame, let's say 5 minutes, most probably it is the same. See here the MNQ and just watch the difference. Almost no difference. So let's back to 1000 tick chart in whatever, let's say MNQ. And let me now explain those moving averages. So those moving averages are the 21 EMA. Okay, one of them, okay, is for the close. So let me draw it this way. So we have it in orange because I like it to be orange. If you want different color, that's be my guest. I use the closing 21 EMA as orange, and I like all my students to do the same, so we see the same thing together. When we explain things, we talk about the orange indicator. That's it. And then we have two. I make it gray. You can make one green and the other one red, but I like it to be gray, so I don't have gray here. Let me see how I do that. So let me make it purple. Okay, so purple, it is gray. I don't have gray in this tool. So 21 EMA for highs, and the other one 21 EMA for the lows. Okay, so we have these are the gray ones or the white ones, and this one is the orange one is for the close. For this one is for the close. The source is close. Then we will talk about the blue one. So let's first of all start with the close. So make sure to make it 21 EMA and the source is close. Okay, and you can make the color here as orange. I will come back later to this one, smooth MA and the smooth one. This one will come later. This is the blue one actually. Then this one is simply the source is the high, and you don't want to use this for it. Style is you can make the highs green and the lows red. Here I'm not choosing anything. And then the low, it is simply the low. The source is low. So now you have a Bollinger or a ribbon moving together. They never intersect, and they cannot be intersect because the high cannot be lower than the low. The high is the high and the low is the low, and the close always in the middle. Yes, there is some time price is getting closer to the highs and sometimes getting closer to the lows. However, they will never intersect. What will intersect is the blue one. So the blue one, how I make the blue one? It is simply clicking the close, the orange one. See why I'm using orange? So the orange one, you just click in the smooth EMA. I like to make it a step line, so it is a little bit different in the shape. And then the input, you make it EMA. Instead of SMA, make it EMA and put the length 21. All right. So now you are set with all that you need. And one thing is very important. I think we need to use also the volume here to be shown. So because this candle, you want to see the volume of this candle. So this is 1000. As you can see here, it is 1000. So you can see the volume of this candle approaching the 1000, so it will close. So most of them are 1000 contract, 1000 something. So most of them are 1000, 1000.1. So it should be 1000 actually, but because the market is very fast, sometimes the candle takes a little bit higher. So whenever it reaches 1000, usually it will open the new candle. So these candles are not time based, they based on how many trades are taken, how many trades. And this is the difference between tick and volume. There is another volume chart called volume, 20,000 volume, which is 20,000 contract. But this one is 20 or 10,000, 1,000 trades. Sometimes the trade could have one contract, and sometimes a trade could be 10,000 contracts. So it's not equal volume. This is just to make sure. So how I am using these things. So first of all, before using this, don't use those as a signal. Don't use touching the moving average as a signal. Not all the time. It will not work all the time. Yes, it works sometime, but it doesn't work all the time. So don't use it as signals. Use it as an indicator, because it is an indicator, guys. It is not a signal. It is an indicator. So indicator that indicates something, that is telling you something, give you information about something, okay? And that's the role of an indicator. Each indicator is giving you information, okay? And how to use that information, you should make a strategy out of that information. So the EMA are helpful and useful in trending days. If the market is trending, it is very useful. If market is ranging, it is not useful. as you can see here, the market start to be trending. Comes to the moving averages, go up. Moving averages, go up. Moving averages, go up. Moving averages, and that was very nice trending move. You can take every pullback, and this is not the case all the time. Don't expect the market will do this every time. This is only maybe 10% of the market, maybe 30% of the market will do this in consistent matter. And here, for example, you can see the market going higher, coming back. It goes up, but what has done? They trap it. They go up, they go up, they go up, and now what they have done? Trap it. Sometimes there is traps, and they go up. Instead of continue from here, they trap it. They trap the move, and then go up. So be careful. Sometimes the market will show you a signal, and they take your stop down and come back again, and etc. So now we have a nice move down here. Okay, so the point here, what is the difference between what is happening here, all these traps, all those nice buy signal, however, you don't make money out of them. You don't make money out of them. Why? Because the blue one is inside the Bollinger. I call it a Bollinger. So you can see here, yes, we have intersection to the upside, and I will come back to that intersection. When we expect a long, when we expect a short, or let's say that way. Let's say it when buyers has control, when sellers has control. So this one giving you a signal that okay, buyers now after this drop down, now they have a control over the market. But having a control doesn't mean that you can buy, okay, just like that. And you will have some traps from sellers, and then the market will go. Okay, and as you can see here, there's a big, maybe there's a news over this one, or the opening of the market, I don't know. I think it's a news, and then the market go up. Okay, then we have yeah, what I'm saying here, why we expect to see those traps? Because the blue one is inside the Bollinger. It is inside the Bollinger. As long as it is inside, so expect some traps. So don't go and just buy from here. Wait until you see a trap, because the market going down and going up, there is no trap yet. Now we have a trap. Yeah, we can take this long signal going higher. And now after this, market doing some traps. You can take this one as well. This one, no, we make it a new high now. Okay, there's a new high. That means don't be fool and take the first one. Wait for a trap. That doesn't mean the trap must come. It doesn't mean that. Sometimes the market just go without a trap, and then you will find this blue line outside the Bollinger. But this is how I use it. Whenever I see the blue one inside the Bollinger, I don't take a trade until I see a trap. I will risk the market will go without me. Fine. But don't fool me. Okay, now here, market made a new high. Okay, don't take the first one. Okay, market, yes, did go. I lost it. I lost this trade. I didn't take that long. I was waiting for a trap, which is happening here. After this drop, we see a nice trap here. Strong green candle. I don't take it because it's below the moving average. I don't take this one, even though it goes a little bit higher. But that means the Bollinger is inside. The blue one, the root. I call it the root EMA inside the Bollinger. So I have to wait. Now we have intersection, another intersection, another intersection. So that is a range. Whenever you see intersection, then another intersection, and the blue one staying inside, that means you are about to have a range. There is a range. Market is going. Sometimes the range could be just rectangle. Sometimes it is triangle. Sometimes it is Doritos or whatever. So the range could be just range, could be triangle, like this, the market moving like this, could be megaphone, could be a megaphone. So all of these are considered to be a range. Now we have the market having the control for the sellers after fighting. Market drop, sellers took control officially, and the blue one is outside the Bollinger. We have a nice short signal here. I don't short here. I cannot. I have other strategy to work with it. I am using these moving averages in many ways, not only that one. I use the intersection to buy here. I will use the intersection to sell here later on when the market reaches there. So there is a lot of uses. It's not one only strategy. I use the curves of the moving averages as a target. The curves of the moving averages as a target for the seller. So there is a lot of uses for those indicators. The simple one, to understand who has control. So now sellers has control. Market going down, the blue one is outside the Bollinger, you can take the sell signal over here. And here the market didn't touch it actually. Didn't touch it, so there is no signal in here because there is no touch. If you miss this one, you can take this one. So that one is a confirmation. That's one first try, and this one the second try. This one the third try. Now this is the first one because after making new low, now you cannot. I will not take this one because the market didn't touch the moving average. Now we have a fake signal here. The market goes up, give me a signal, and it is triggered. The stop is here. Yes, I lose, but I lose only little. When I make money, I make a lot. That one could be a loser as well. The market could go just higher and take me. So I'm risking this to make 2 to 1 maybe. 1 to 1.5. Okay? And the market now is stalling inside. I don't buy, I don't sell. The blue one is inside. The blue one is inside. Still inside. There's a fight. Now we have a breakout up there. Now I wait for a test. Now we have a test here. It is a stop loss. Now we have a stop loss of this long. This one, there is a stop loss because I don't like this candle. However, if you bought after this candle, this is your stop loss. That's it. You exit. Wait for the next one. There's no one yet. And we have it back again. You wait until the market give you another. This one is another nice signal to buy. The most beautiful thing about this, it will save you from going to the wrong direction. Yes, you can go long and lose. How about if you go short? If you go short, you will lose more, actually. So this will give you who has control. This is the use of the moving averages that I'm using, which I have a lot of questions regarding. So this video is explaining how I am understanding who has control. Again, if you see the moving average inside, avoid trading. You see a test, you take it. Okay? And the test should be the moving average outside the Bollinger. So you can take it here. And again, Be careful, even if the Bollinger is out, make sure those moving average are not in range or smoothing or flattening. They should be like this. You can see here, they are going lower, they are going lower, they are going lower. Here it is ranging, because at the time you can see it is ranging, so you cannot. And also the blue one is inside. That's it. Don't trade. No trade using those moving averages. Maybe there are other strategies that you can use, but for this one, moving average inside, the Bollinger is flat. Just wait, wait, wait. Bollinger is outside. Moving averages are heading down. Are heading down. Take it. Now, you can see it here. The Bollinger is flat. Don't be fooled to take the first one. Maybe you can take the second one. Okay, because the stop, you can see they just trap those sellers with one tick and go. Okay, now it is flattening. Don't sell. Oh, now we have intersection. You can see you don't want to be in this. You don't want to be a seller. You don't want to be a buyer in this. When I do buy, I wait for the market to come back to me. They don't come back. They come back with a very weak green candle. Nothing. 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 I cannot take it because the moving average is inside. So the moving average sometime will let you take a fake signal like this one. Sometime it will let you miss some trades. Sometimes to let you miss some trades. This is why I have different technique to go long. For example, this one is a short, a long trade for me, using not only the buyer's trials, because the entry setup, I have around 8 entry setup. 8. One of them is this one, is whenever you have test, buy, 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 buy. This is called buyers or controllers setup. Buyers are in control, wait for strong try, take it. Trials for buyers and sellers. This is one setup only. There is another setup for intersection, another setup for limit, another setup for the Bollinger setup. We can talk about this later on in different videos, but for now, this is an explanation of the moving averages. You use it as you see fit. Take care, and sorry for taking this too long. I meant to have it only for 10 minutes. I don't know how it becomes 23. I will try to cut it short in the production. Thank you very much. See you in Top Step TV.